Welcome to The Explainer. We're diving straight into the fascinating world of the AI supply chain today. Now, when we talk about the artificial intelligence boom, we're usually talking about software, algorithms, or chip designers, right? But today, we're going straight to the factory floor. We're going to explore how electronic manufacturing giants are capitalizing on this massive technological shift. Specifically, we're breaking down the strategies of two industry heavyweights, Jabil and Flex.
Here's our game plan for today. We'll start with Jabil's blockbuster quarter, then look at the AI infrastructure bull case, followed by the bear case on margins. After that, we'll do a head-to-head strategy comparison with Flex, and finally, evaluate their manufacturing moats. Let's get right into it.
Section 1. Jabil's blockbuster results.
So Jabil is fundamentally a legacy hardware manufacturer. They design and build plastic and metal components, enclosures, and electronic hardware. So a great question to start with is, why on earth is an old-school manufacturer like this suddenly outperforming the broader, tech-heavy S&P 500?
I mean, the outperformance is literally staggering. Just look at the numbers. Over a recent 52-week stretch, the S&P 500 put up a very solid 16.7% return. But Jabil, their stock surged an unbelievable 90.7% over that exact same window. This legacy manufacturer has completely left the broader market in the dust. And the engine driving all of this, it's the explosive, insatiable need for AI data centers and the actual physical infrastructure required to house them.
And this hype is heavily backed by the recent earnings. Jabil just delivered preliminary third-quarter net revenue of $8.8 billion. Alongside that massive top-line number, they posted a core EPS of $3.16, entirely beating Wall Street's expectations. So this demand isn't just a fun story, it's showing up as billions of dollars on their income statement.
But the crucial takeaway is how management is viewing the future based on this quarter. Riding this momentum, Jabil's management confidently bumped their fiscal 2026 outlook, setting a full-year revenue target of a jaw-dropping $35 billion. They cited better-than-expected performance in automotive and connected living, sure, but the undeniable star of the show here was strong AI infrastructure demand.
Which leads us to Section 2, the AI infrastructure bull case.
To really get the bull case, we need to understand the customer. You're going to hear the term hyperscaler a lot in this space. Basically, a hyperscaler is a massive cloud service provider. Think of companies like Google. They require an absolutely unprecedented amount of computing power and data center infrastructure to train and run these large AI models. These hyperscalers are the engines underneath Jabil's current financial momentum. They are the ones writing the massive checks to build the physical backbone of AI.
And just look at the size of those checks. Jabil's management projects that their AI-related revenue alone will hit approximately $13.6 billion in fiscal 2026. To put that into perspective, that is a stunning 50% jump in AI-related revenue year over year. And management even noted they expect the percentage growth in fiscal 2027 to be similar, even when starting from that much larger baseline.
What's really interesting is this isn't just about growing their existing accounts. Management specifically pointed to, quote, winning our third hyperscale customer as a key driver. This is a big deal because it proves they are actively expanding their partnerships, grabbing more market share at the very top of the cloud food chain to sustain this explosive momentum well into 2027.
All right, let's flip the coin. Section 3, the bear case on margins and risks.
First, let's just ground ourselves in the sheer, massive scale of this operation. On a trailing 12-month basis, Jabil brought in roughly $33.6 billion in revenue. It is a true manufacturing behemoth.
But here's the stark reality check. Despite all that revenue, Jabil operates with a razor-thin 2.6% trailing net profit margin. Now, yes, that is slightly up from 2.0% a year earlier, but it still grounds us firmly in manufacturing reality. When you only convert 2.6 cents of every dollar into net income, there isn't a whole lot of room for error.
So the bears are raising some very valid red flags. First, what if this AI and automation demand turns out to be highly cyclical? Second, they are heavily reliant on these massive physical infrastructure projects. And third, Jabil carries pretty high debt levels compared to industry averages. The skeptical question is simple. Can their $862 million in trailing net income survive if hyperscaler tech spending suddenly slows down?
Now, let's bring Flex into the picture in Section 4, Strategic Choices.
This is really the macro business strategy question of the hour. If you are a giant electronics manufacturer, How do you actually structure your company to best capture this AI boom while protecting those precious margins? Do you keep everything together, or do you break it apart?
It's fascinating because these two giants are taking completely diverging paths. Jabil is sticking with a diversified all-in-one model. They want to keep everything under one roof, arguing that their massive scale provides unbeatable purchasing and engineering synergies. Flex, on the other hand, is executing a split or spin-off approach. They are actually planning to spin off their cloud and power infrastructure business into a pure-play, hyper-growth AI vehicle by early 2027, leaving the rest of the company to focus on more stable markets like healthcare.
When we put their financial profiles side by side, a clear duel emerges. Flex already operates a slightly more profitable business across the board. They've got a 5.2% operating margin compared to Jabil's 4.9% and a 3.2% net margin versus Jabil's 2.5%. And because of this cleaner profitability, along with the strategic clarity of that upcoming spin-off, the market is giving Flex a premium valuation. Flex trades at a price-to-earnings multiple of 34.7, while Jabil sits lower at 27.6. So Jabil is the cheaper stock, but Flex is viewed as having higher quality margins.
Finally, let's look at Section 5, Building a Manufacturing Moat.
A moat, as you know, is what protects a company's future profits from competitors. JBL is betting big on scale and synergy. Their argument is that by doing everything, they can cross-sell. They can start a relationship with a customer on one small product and eventually expand that to cover the entire data center. Flex is betting on a focused, pure-play moat. They believe that extreme focus in their new spun-off entity will allow them to build highly specific capabilities in power, thermal, and compute systems that a diversified giant simply won't be able to match.
Now, both of these strategies carry immense structural risks as they navigate this cycle. For Jabil, the risk is that this incredible high-growth AI value remains forever buried inside a massive, blended, lower-margin portfolio, meaning the market might never fully reward them for it. For Flex, the risk is purely operational. Executing a complex corporate breakup is hard enough, but they also have to fund massive capital expenditures for the new spinoff, which are set to more than double to a range of $1.4 billion to $1.6 billion in fiscal 2027.
Which leaves us with this final, provocative thought. Both of these companies are swimming in the massive demand generated by the AI data center build-out, but they're offering investors two entirely different vehicles for the ride. So looking at all this data, what's your take? Are you willing to take on the spin-off execution risks for the pure-play AI potential and higher margins of Flex, or do you prefer the cheaper, diversified, all-in-one manufacturing scale of Jabil? The AI supply chain race is really just getting started, and how these companies structure themselves today is going to determine who ultimately wins tomorrow. Thanks for joining me on this explainer, and keep learning.